Hello and welcome back to our second video. In this video, we're going to talk about ROI. So we're going to see how to compute ROI, but more specifically, we're going to look at how ROI changes when we have changes in sales, expenses, assets. So the return on investment formula, super easy, right? What we need is we need net income and we divide it by our average operating assets. Now, up to this point, we only really looked at the traditional income statement and we looked at the contribution margin formatted income statement. Here, when we're calculating ROI, we need to figure out what net operating income is, okay? Not net income, net operating income. And to calculate net operating income, really what we're taking or what we're looking for is what's our income before we subtract any interest and before we subtract out our taxes, okay? So we call that EBIT, earnings before interest and taxes. That's our net operating income, okay? We take that and then we need to also account for our average operating assets, right? So basically, we're looking at total assets, right? Cash, AR, inventory, PP&E, any productive assets that we have. The catch is we need to calculate what the average operating asset is. Super easy to do, right? You take your assets at the beginning of the period plus the assets that you have at the end of the period. You add them up, divide by 2. That's it. That's it. Pretty simple. Okay? So we need to look at book values and gross cost. Okay? So if you remember from financial accounting principles or the Harvard Business Review course that you had, a lot of companies use book value to calculate the value of their assets, right? They have to do this because that's what GAAP says. So we take the acquisition cost of the asset, meaning what did we pay for the asset, and we subtract out any accumulated depreciation. That gets us at our book value, okay? So what we need to keep in mind here is as we're looking at the average net operating assets, the net operating income, we have some accounting numbers in here that kind of throw off our calculation. Once you get into Corp Fin or corporate finance, you'll see that when we're looking at accounting information from a financial perspective, from that financial perspective, we just want to know what the cash flow is, right? We don't care in corporate finance. We don't care about non-cash expenses or anything like that, okay? So let's take a deeper dive into ROI, okay? And really, return on assets is made up of 2 things, right? First, it's made up of our margin, and the second thing it's made up of as our turnover. So there's actually 2 ways to calculate ROI. First, we could take the net operating income divided by the average operating assets. That's acceptable. Or we can break ROI down into its 2 parts, margin and turnover, right? So what's margin? Well, basically, we're trying to figure out how much net operating income we get from our sales, right? So to calculate that out, we just take our net operating income and we divide by our sales. That gives us our margin. Turnover, we're looking at how effective are we at utilizing our assets, right? So we take our sales and we divide it by our average operating assets. If we multiply margin and turnover together, that gives us our ROI. So ROI is just another way to calculate return on investment. Okay, So let's look at some examples of ROI. And let's say that the Regal company reports the following. They have net operating income of $30,000. They have average operating assets of $200,000. Sales is $500,000. And their operating expenses are $470,000. What is their ROI? Well, we can very easily calculate this, right? We could take net operating income and we could divide it by our average operating assets. Or we could look at it based on its parts, right? Meaning the margin and the turnover, okay? So calculating ROI that way, we take our margin, which remember what the calculation is for margin. Net operating income divided by sales multiplied by the turnover, which in this case in formula form is sales divided by net operating assets. So if we look at ROI from this perspective, right, we could see that our ROI is 15%. Again, we're taking our margin times the turnover. So let's assume for a minute that before we get there, we're going to change some things now, right? What happens if our costs increase, right? Meaning we purchase more operating assets. Maybe our operating expenses change. How does that impact our ROI? So let's assume for a moment that the management of Regal decides to invest in a $30,000 piece of equipment. This is going to increase our sales, okay, by buying this new piece of equipment. But it's also going to increase our operating costs as well, okay? So we need to figure out what's our new ROI, right? So let's think about this. So here's what Regal has. Here's what they reported. They have net operating income, $50,000, $230,000, average operating assets, sales, $535,000, and operating expenses are $485,000. Now, these numbers are the same as the numbers before, right? Let's go back. They're the same exact. Oh, nope. They're not the same, but those numbers don't work out. Yeah, because net operating. Oh, yeah. I'm sorry. We're good. The net operating income, they just calculated based on the increases in all the numbers. Okay. So how do we calculate this new ROI? Well, again, we're going to break it down into its pieces, right? I know someone's going to ask, why do we have to break it down into its pieces? Why can't we just calculate it the regular way? Because we get more information by breaking it down into its parts. We see what its margin is, what the turnover is, and how those are impacted, right? So if we calculate ROI based on margin and turnover, we take our increase in net operating income, which is $50,000, our new sales figure, which is $535,000, we get 9.35% operating margin, okay? We get sales divided by average operating assets. To calculate our turnover, we get 2.33, okay? That equals 21.8%. So our ROI increased from 15% to 21.8%. But here's the kicker. Let's look at the original example. Our turnover was 2.5% or 2.5, okay? Our turnover, based on the new assumption of increasing our costs, our turnover went down. So we have a lower turnover rate, okay? So keep that in mind as we're calculating ROI. We're looking at it from its pieces, and we're saying, okay, what's our ROI? But we can determine, well, our margin went up, but our turnover went down. Okay. Overall, we did have an increase in ROI, which is good. Okay. So we talked a lot about ROI. We saw how to calculate it. We saw how to break it down into its pieces. And we said that, ROI is a pretty important number, right? It is, but it's not without its faults, right? Think about it this way. ROI just looks at two things, margin and turnover, right? There's a whole other realm of criteria that we should be looking at that ROI does not, okay? So in order for ROI to really be important for us and to really offer us value, we need a balanced scorecard, okay? Why? Because we might not know how to increase our ROI, right? If I said to you, based on this, how do we increase our ROI? Well, increase in sales would help, right? Increase in our average operating assets. Well, that's going to drop our turnover, right? But the increase in net operating income with the increase in sales really drove that ROI change, okay? So what we're saying here is basically ROI is great, but as long as we have, to even make it even better, if we have if we have a balanced scorecard with it, then we know exactly how do we increase ROI, okay? Another criticism of ROI, because we're using average operating assets, think about it. How long do operating assets last? Well, probably a while, right? 10 years, 15 years, maybe 20 years. So the problem with ROI is that if we get a new manager, that manager is going to inherit costs that manager has no control over because they didn't make the decision, okay? Another problem or criticism of ROI, if we just use ROI to evaluate investment decisions, should we invest in a project? Should we invest in a new piece of machinery? Whatever. It's possible that managers might reject investment offer or profitable investment opportunities just solely looking at return on investment. Okay? So now that we have return on investment under our belts, we need to look at residual income and understand A, what it is, how we calculate it, and what are the strengths and weaknesses of residual income. Okay? So when we calculate residual income, basically it is the net operating income above some minimum return on operating assets. Say that again, because it's pretty important, right? Residual income is net operating income above some minimum return on operating assets. So as a company, we're going to set up guidelines that says we don't invest in anything unless we get a return of X. Okay? That's what we're saying here. So how do we calculate residual income, right? Well, it is different from ROI, so we got to kind of learn a new formula here. But if we take the average operating assets and multiply that by the minimum required rate of return, we need to subtract out our net operating income from that, and that gives us our residual income, okay? So when we're looking at ROI, that measures the net operating income earned that's relative to the investment based on the average operating assets, right? Residual income takes a totally different perspective. What we do in residual income is we're measuring that net operating income that's earned less some minimum required rate of return, okay? So two different versions of measuring performance, right? One says, here's your return on investment based on your average assets. Residual income says, nope, we're going to measure that net operating income that we earn less some minimum required return on average operating assets. So let's look at an example here, okay? So the retail division of Zephyr Incorporated, if you guys remember Skids, I think they used to make the Skids brand clothing, I think. Are those like parachute? Anyways, all right, moving on, sorry. So the retail division has average operating assets of 100 grand. It's required to earn a return of 20% on these assets. They tell us that in the current period, this division earns $30,000. That's going to be their net operating income. We need to figure out what is the residual income. So super easy, right? They tell us that the operating assets, we have $100,000. The required return on those assets is 20%. That means our minimum return based on these assets is $20,000. So what's the residual income? Well, we take our actual income, 30 grand, minus our minimum required return. We get residual income of $10,000. Okay? So let's look at residual income. What does it do for managers? How are managers going to use this, right? We already said that ROI is good. Managers can use it. In the absence of a Balance ScoreCard, managers might not exactly know how to increase or how to affect return on investment, right? We said that using ROI alone, managers could reject profitable investments. So what if we use residual income? Well, if we use residual income as a basis of our decision, residual income encourages these managers to make profitable investments that they would have rejected if they were using ROI. What's the point of this? The point is there's many different ways to look at return on investment, right? If we as managers are holding our subordinates responsible for making decisions, we want to make sure that we have a good measuring stick. ROI is good, but not by itself. If we use ROI and residual income to make a decision, that should ensure that we're making the best decision, right? Because ROI says we're going to reject a profitable investment. Residual income says, you know what? Under ROI, you might have rejected it, but based on residual income as a measuring stick, you're going to accept that that profitable investment or that profitable project. Okay? I'm just going to blow through these quick checks on how to calculate residual income. We'll work on those on some problems. So we know the advantage of residual income, right? Number one, it's pretty easy to calculate for the most part. Number two, it will ensure that managers are accepting profitable investments or accepting profitable investment projects where ROI says, you might not want to invest in this. However, there are some disadvantages with residual income. In fact, there's one major disadvantage, right? We cannot use ROI to compute or to compare performance of divisions that are of different sizes, right? Let's take a look at this. So let's say that we have the Zephyr information, right? They had that one division. They had operating assets of 100,000. Let's compare that to a wholesaler, okay? Or let's say that Zephyr Incorporated has a wholesale division. So we're going to compare and see, hey, which division is more profitable, right? Okay, well, let's look at it. Based on operating assets, the wholesale side has 10 times the number of operating assets that the retail side does. Okay? They both have the required minimum rate of return, which is 20%. So if we look at the retail side, 20% is their required minimum required return. Their residual income is $10,000, right? But look at the wholesale division. The wholesale division has actual or operating income of $220,000, but their minimum required return is $200,000. So their residual income is higher, right? Does that mean that the wholesale division is more profitable and better than the retail division? Well, not necessarily. We can't tell, right? We're not comparing apples to apples here, right? So that's the main disadvantage of the residual income. Okay. Based on this, just based on looking at these results, we would say that the wholesale division actually outperformed the retail division solely based on the fact that the wholesale division has $10,000 more residual income. Okay. But remember, ROI, when we calculate ROI, it's based on the margin and the turnover. Okay. So if we look at it from an ROI perspective, Zephyr had 30% return on investment compared to the wholesale division, which had 22%. Okay. So actually, based on that, the retail division did better because they had a higher return on investment. Okay. The key takeaway here is really that you can't say that one division's better than another division based on residual income, unless they're the same size. Okay. Throughput time, delivery cycle time, manufacturing cycle time. Basically, what we're saying here is we're looking at a manufacturing process. And we said that there's time, obviously, right? We have from the time we receive an order of raw materials to the time we ship the good, okay? There's throughput time and delivery cycle time, right? Basically, throughput time says that, okay, I'm going to start production. I have processing time that I need to factor in, inspection time, move time, and queue time. Okay? That's the throughput time. Basically, what we're saying is from the time we take our raw material and we start producing, it's going to take time to process, right? As we're doing something, let's say we're making a bicycle, right? It's going to take time to process that bicycle, right? And especially as it moves from station to station to station, there's move time, right? I got to have somebody come and move this lot of bicycles over to the next department. And then once it gets to that department, it's going to sit in queue and it's going to wait for that department to add some labor, to add some materials, to add some overhead, okay? And then usually finally at the end, we have inspection time. We need somebody, a quality control person, to come in and sit on the bike and make sure the gears move and the brakes work and all that good stuff. So when we're looking at the delivery cycle time from the time we order to the time we ship a good, there's a lot of elements of time that come into play, okay? So as we look at this and we think about it, well, what adds value to the final customer? Us waiting on a shipment, does that add value? No, not at all. The move time, the queue time, the inspection time, none of those really add value. The only time that really is a value added component is going to be the process time when they actually make the product. Okay? So, how do we calculate manufacturing cycle efficiency, meaning how efficient are we managing the operations from ordering or receiving an order to delivering the good? To figure that out, we take the only value-added time, which we already said is process time, and we divide it by the manufacturing cycle time. We'll go through some of these on in our when we go through some example problems. Last thing really is this balance scorecard. And this really shows that there are a number of areas that we can use as performance measures, right? We already looked at 2 financial measures. We looked at ROI and we looked at residual income. But there's 3 other very important performance areas that we need to look at. Customers, customer satisfaction, customer spending. We need to look at that. We need to look at learning and growth. We need to look at our internal business processes. So these 4 items really make up the balance scorecard. And basically how the balance scorecard works is we start off with looking at learning and growth, really, right? Are we maintaining our ability to change and improve? And we're not just talking about a product, we're talking about the entire company. Is the entire company learning and growing, right? Are they able to change? Are they able to improve their products? If they are, then that's going to increase their score on their balance scorecard. Then we need to look at the internal business processes, right? Have we actually improved key business processes? Have we become more efficient? Are we delivering more value to our customers? If we have an internal process that adds value to customers, that's going to help out our balance scorecard. So when we're looking at using the balance scorecard, we really start off with vision and strategy, right? What are our financial goals? What do our customers want? How can we serve them? How can we, build brand loyalty and repeat customers, right? What internal business processes are critical to providing that value to customers? So at the end of the day, we're not just looking at financials. Hey, did we have a good return on investment? Yep, sure did. Okay, great. But if we don't look at the customers, if we don't look at our internal business process, or internal business processes, those 3 things are really the business process drives customer satisfaction, brand loyalty, which leads to the improved financial performance. Okay, that's pretty much it for the balance scorecard in chapter 11. What we're going to do is we're going to come back in our next videos. We're going to do some demo problems. We're going to work with how do we calculate certain things and just kind of go from there. Okay, so tune back in for those videos.